listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Share structure is something we hear about constantly, and especially if you're a new investor in the junior mining space. The majority of these companies raise capital through equity, and so dilution is a constant. Hence, a lower number of shares, is better. It is important, more important actually, for a company to have a limited number of options and warrants. However, what really matters is the potential of the company to add value relative to that constant of dilution. When researching companies, I assess their potential value in 2 or 3 years against the capital required to get there and what their share structure might look like in 2 or 3 years. And looking at my favorite holdings now and most successful recent investments, share structure was and is not a strong suit of these companies. It costs money and shares to add value. 100% dilution sounds awful, but not if the company is tripling its production or tripling the value of its deposit through successful exploration. 2 of my favorite exploration companies have bad share structures, but they could be on their way to proving they have near tier 1 level deposits. In the past few years, I can recall 2 exploration companies I invested in that did not perform well. Their tight share structures were a big selling point. Prospect generator companies have the best share structures and remain that way for a long time, but they are weak at value creation unless they get lucky and make a discovery. One thing we neglect to remember is the impact of global monetary inflation on share structures. The world is more expensive than it was 10, 20, and 30 years ago. Thus, it's more expensive to be an exploration company today. You have salaries, property acquisition costs, drilling costs, holding costs, etc. It's all more expensive than it was in the past. Thus, it takes more shares to pay for all those things. So 200 million shares out today may be equivalent to 125 million shares out or 150 million shares out 10 or 15 years ago. Share structure is more important for earlier stage and pre-IPO companies when assessing what a new company could be worth immediately or in 12 to 18 months. Share structure plays a big role in that calculation. But for everything else, in established companies especially, share structure is an overrated fundamental. What really matters most, and what we should focus on most, is that company's potential to add value. Dilution is a constant. Adding value is not. Find the companies that can add the most value. I'll discuss what adding value means in my next editorial. Thanks for listening.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.